With us today, we have Fathom Consulting, who has been monitoring the consequences of COVID-19 since the pandemic began. Consequences looking at economic, financial, and geopolitical. And while the economic fallout has been severe, Kevin's here to share with us Fathom's views on what potential recovery would look like, share with us their views on the pandemic and the economic recovery. So thank you, Kevin, for joining us. We are very grateful to have you here. Kevin Lone, head of Fathom USA, will be walking us through what's new, what have we learned about the virus and the initial economic impact, what's Fathom's central scenarios, and the long-term consequences. So without further ado, I will hand it over to Kevin to walk us through his presentation. Thanks so much.
Thank you both, and thank you all for joining this presentation today. So clearly the past few months have been a complete shock to everybody and probably been challenging for everyone in different ways at times and continues to still be so. This presentation maybe is going to have a slightly more optimistic tone than some others that you may have seen or some different reports that you may have seen. But I'd like to outline our views and how we're thinking about the impact of COVID and also the shape of the recovery that's to come. Before we kick off, just a quick pulse check for the audience, kind of maybe to put things into context a little bit. We wanted to kick off with a poll question. So here we're just asking you, over the past 3 months, your views about the economic recovery and whether they've changed and in what way. So over the past 3 months, has your view about the economic recovery become more optimistic, more pessimistic, or unchanged? And so 3 months ago, you can think of as end of March or beginning of April time. So I'll leave the poll open for a second, and I'm going to close it now. Okay, so fairly even split. 33% unchanged. So third unchanged, a quarter more optimistic, and 40% more pessimistic. So pessimism wins the day for now, and that matches fairly well with our slides. We can give the audience perhaps what they were looking for. So I'm going to kick off with the bad first to highlight why people might be pessimistic, fairly understandable given the current situation. Then I'll give you some of the good, and there has been some good news in our view, at least. And then I'll also close with the unknown, and I guess that's the big question moving forward. So the bad, probably could have made this very long, but keep it fairly short. But from an economic perspective, at least, this is hopefully going to be the deepest recession any of us will ever see. Certainly, it's the deepest recession any of us have seen so far, at least any that's been recorded. This plots the average depth of recessions going back almost 200 years. This is across a range of countries. You can see where the green bar is highlighted. We're looking for around a 7% fall in global GDP this year. If that's to pass, that would make it in the top 5% of worst recessions ever. So you have seen bigger declines, up to half loss in GDP, 50% decline in GDP. But usually that requires either sort of a natural disaster on a very small island or war. So if you exclude war and go back in time, this is really the deepest thing we've seen, and hopefully it's the deepest thing any of us will see moving forward. And then in terms of the speed or the length of the recession, for us, this is going to be fairly atypical. So this plots how long recessions average, how long it takes or how long they last. And so, yeah, on average, recessions they were over within a year, and that's what we expect here. In fact, for this recession, if you're looking at the US alone, you could argue that the recession probably lasted a month. If you're measuring from when GDP began to contract to when it began to expand again, I'd say it's fairly conclusive evidence at this point that you could say it started to decline some point in mid-March and then started to increase around 1 month after that. But it was a very, very steep fall. So within that very, very short period of time, we've managed to lose an awful lot of economic activity. If you look at it just from empirical perspective, and again, this is looking at the experience of lots of countries over a very long period of time, the speed with which a recession, how quick you fall into recession tends to tell you something about how fast you come out of it. And so on that basis alone, a very sharp decline in GDP tends to be followed by a fairly sharp increase thereafter. So if you look at the light blue lines, that shows the Great Depression, and that's clearly one risk, and probably something that some people on this call would be worried about, is that we have a very sharp fall and then a shallow recovery. And that's what we saw with the Great Depression, and hopefully that's something that we'll be able to avoid. So if we get on to the good, so not to understate the enormous decline in GDP, I think the good is that the recovery has begun. And I think if you scroll back, if you asked me in April, I probably would have been much more pessimistic in terms of the near-term outlook, really, than what has transpired. When the whole world was going into lockdown, it really felt scary. On a personal level, I was in New York at the time, and to see a city of that size and vibrancy essentially go dark overnight, it was scary from a health perspective, from a personal perspective, and it really did seem that the whole world maybe would have to remain locked up for months and months, and perhaps we just get food and that would be it. Luckily, it hasn't been as bad as that. One way of representing that is in equity markets. So as this chart shows, you see a really, really sharp decline in March. That period, I think, where it really clocked in many places around the world that this was an extremely serious situation, and that's when governments really started to enact lockdowns. So the decline in GDP was or in the S&P 500 was much steeper than what we saw during the global financial crisis. And I think that's just because this was a completely unexpected shock, and there was huge uncertainty around it, and so investors are really unsure about how all of this would play out, investors and people too. Since then, you've seen a big recovery. Some people might say that's in large degree thanks to what central banks have done. We would definitely agree with that, but I think it's unfair to say it's simply asset price inflation. They're just printing money and that's what's causing it. But I think you have to give central banks and policymakers in general a lot of credit for their response to this crisis. So on this chart, we have global quantitative easing, and this is just one of the measures that central banks around the world have put in play. There's been a whole range of policies, both in terms of widening the assets that are eligible for purchase, both in the US and in Europe, as well as, in the Fed's case, a commitment to unlimited purchases that's really not only supported asset markets artificially, but all of that support really prevented what at the time was a liquidity crisis, prevented that from turning into a solvency crisis. So things could have been much worse if that completely unprecedented shock that I've been discussing turned into a financial sector blowout, for example. And if we had a banking crisis or a financial crisis, then I think all of the other metrics and all economic indicators would have been a lot worse. So I think you have to give policymakers credit for the speed and scale with which they've acted. And within that, I think I would also include politicians around the world, particularly those in advanced economies. Central bank action has clearly made it a lot easier for them to borrow a lot, and they've been diving in with open arms, so to speak, in terms of really trying to do as much as they can to support economic activity. We think that's right, both on moral grounds, because a lot of economic activity probably was legally not allowed to occur. So if you're ordering places to shut and telling people that they can't go to work, there is a moral argument that the government should step in and say, we're going to make you whole on that. But it also makes sense from an economic perspective that fiscal policy would step in here and ensure that this short-term crisis doesn't have second-round effects, that people who were previously employed don't become long-term unemployed, and that businesses that were previously viable don't become extinct. That would reduce the supply side of the economy and would make that short-term shock much, much worse. So I think, if you look at the US, it's at around 10% of GDP. And I think that's been really helpful in supporting the economic recovery that we've seen so far. Our own view is that will be extended. The Trump administration is talking about $1 trillion additional borrowing at as the next fiscal package, and we would support that. I think if we move to the next slide, part of the reason why the recovery has come so quickly and probably been much faster than we had expected and that many other people had expected is due to that very, very large fiscal support. And it would sort of defeat the entire purpose to look at that recovery and say, okay, well, job done now, and let's remove it. So this chart is showing U.S. employment during and after recessions. And so what you can see is that completely astronomical decline when 20 million people became unemployed in April, completely never seen before in terms of labor market data. But since then, around a third of those jobs have been recovered. And so it's been a much steeper fall than any other previous recession, but the rebound has come much earlier than it ever has before as well. And so it's important to keep that in mind. So for example, normally it would take around a year before you started to see jobs increasing or employment increasing. And so we saw that within a month and a half, so to speak. So you can say mid-March to April, jobs are being destroyed. But from May and then in June, we've seen around 7 million in net employment creation. So for us, that's really good news and definitely better than we had been expecting if you scroll back a few months ago. And so some of that strength, or at least less weak employment data is also reflected in things such as retail sales. And so you see that big decline, 20% drop year on year in US retail sales. But in May, retail sales were around 6 or 7% below where they were a year ago. And so a lot of that, I think, has to do with stimulus checks and with enhanced unemployment. And it really makes sense to ensure that people are able to continue to spend, particularly in an economy that relies so much on consumer spending, such as the US. It makes sense that the fiscal support should be there so that people could continue to do that. Again, if you asked me in March or April, where would US retail sales be in May? I would have thought maybe 15%, perhaps even worse. So that's, in my view, it's bad news, but it's less bad than it could have been. So it seems that there is a foundation for a recovery and for a rebound. And if you look to China, where the virus originated, and where essentially they're kind of a couple of months ahead, the US and Europe at least, there is signs and there's widespread evidence that an economic recovery can be achieved. That there doesn't necessarily need to be a protracted slump, that there aren't necessarily going to be massive dislocations and severe second-round effects. And so here we have Chinese industrial production data, but there's a range of measures that you could look at, and you would see some quite positive data coming out of China. And in our view, that's something that can be achieved around the world as well. But we do need to get the situation under control. Clearly, the virus is pretty well contained in China at this point, even though it was the origin of the outbreak. But this is one way for us judging the severity of the outlook moving forward. It shows unemployment on people who report to be unemployed on a temporary basis and people who report to be unemployed on a permanent basis. And so what you've seen is that most of the action, so to speak, in the job market has been with the green line, where people were temporarily laid off, either because their business couldn't operate. And those are also the same people who are finding work. So you've seen a massive increase there and then a pretty good decline. But the dark blue line is showing people who are permanently unemployed. So I think the longer you stay in kind of limbo where society can't function effectively, then the more likely you are to see more people transitioning from that green line into that dark blue line. And if that is to transpire, that's really going to provide pretty severe headwinds to the recovery, because we know as people become long-term unemployed, it takes them time to find work, and they lose their skills, and the outlook would become worse accordingly. So overall, we think, yeah, there are grounds for recovery, but it does require containing the virus to some extent. And that brings us to the unknown. I'll get into a little bit of our thinking here. And a lot of our relative optimism comes from our analysis of what's gone on with the virus, not in any specific country, but across countries and also across individual US states. So I'll kick off by putting in a big disclaimer. We are not epidemiologists, but we have probably been reading more about epidemiology than we have been about economics, both from a personal perspective and from a professional perspective. I'm sure all of us are following latest developments. The second thing is that we do have strong statistical skills. And so what I'm going to show you is using our own economic skills to try and analyze what's happening with the virus, to try and make some form of informed judgment about what's going to come next. So on the optimistic side, and depending when you're dialing in from, probably now may not be the time to be sounding optimistic, but if you look across the world, and here we have a range of different countries and different locations, and different sets of policies that have been implemented, I think the evidence is fairly clear that the virus can be suppressed and it can be contained. At least the first wave, both in Asia, where there were fairly minor outbreaks and the virus was suppressed and then contained, or in Europe, where you saw large outbreaks and then the virus was suppressed and then contained. I think it's safe to say at this stage that there's evidence that, yeah, a range of countries and policies are able to do this. I think there was a point, at least from my own perspective, where I was fairly defeatist, that there was almost nothing we could do, and this was going to, be a terrible ongoing thing for years, months, if not years. But that's not necessarily the case. Clearly, there's a big unknown about a second wave and what can happen in the winter. And just because places have managed it so far doesn't mean that they'll be able to continue to manage it. But so far, the evidence is clear on that. One of the obvious standouts is the US. And so the US, I think, we would see what's happening currently in the US as more of a continuation of the original outbreak. So more of it's not really a second wave. The first wave has just gotten worse. And the reason we would say that is that a lot of the increase in new cases are occurring in states that never really suffered large initial outbreaks. And so the US, we would say, isn't really suffering a second wave. But clearly, what's happening in the US is concerning and does raise some question about our optimism about the path for the recovery ahead. So I won't bore you with this, but you can look at this if you're familiar with e-views or statistics. You can look at our regression. And so we've essentially analyzed the spread of the virus across over 100 countries. I'm very happy to take questions on that, but I've hopefully made it a bit simpler and a bit more intuitive. And so we're trying to explore how does the virus spread. And so if you start with a place that has 100 cases, so to speak, if there were 100 cases a week ago and you don't do anything, then there'll be 235 cases in a week. That's what we find statistically based on confirmed cases around the world. Now, clearly this is very fast, and if you continue to scroll that forward, you're in exponential growth, and your entire population in pretty short order is going to get infected with the disease. So that's clearly one reason to be very pessimistic. But some grounds for optimism in terms of what we found are that, A, we have policy levers to try and stop the spread of the virus. One of the most obvious, and the one that's been used pretty much everywhere around the world, is some form of lockdown or stay-at-home order. And so here what we find is that if people spend 25% more time at home, that is enough to keep the spread of the virus essentially unchecked. So you can think of this as the reproduction rate. It's fairly close to what scientists estimate to be the reproduction rate of around 2.5. Just lockdowns alone, you're able to essentially nullify the virus and sort of, you're not bringing it to zero, but you're going to keep it at the level where it is at that stage in time. Now, obviously, lockdowns are extremely blunt tools, and they have severe consequences in a whole range of ways. And so, if that's all we had, then it would be a pretty dire outlook. But what we also find is that over length in time, so as countries, the longer a country has had the virus, and for here we're defining countries having more than 100 cases, for each day that passes after a country has had 100 cases, there's something that nullifies or at least erodes the propensity for the virus to spread. And so we don't really know what that is, but over time what we find across countries and indeed across individual US states is that after the initial outbreak, there's something that is essentially decaying the spread of the virus. And it's really this finding that gives us some optimism about the path that lays ahead. To illustrate this a bit more intuitively, this is the simulated reproductive rate, the R rate, how many people an infected person goes on to infect. And you can see it starts at above 2. And the blue line shows what happens with the reduced mobility. So this is observed mobility in the United Kingdom, according to Google. And you can see that the lockdown brought the spread of the disease to around 1. But the lockdown here has been eased over the past few months. And so if it was just lockdowns that were causing the virus to go away, we would have expected the spread of the virus to start to increase since those restrictions came in. In fact, we haven't seen that. And what we've seen is that green line. It started to erode, and the virus hasn't been able to spread as effectively as it had been before. So this is very positive news because it means that countries and societies should theoretically be able to ease restrictions without severely increasing their caseloads in terms of the spread of the virus. You know, we've been reading all of the literature, and other people have noticed similar things, and so there's different theories as to what may be causing the decay in R, so to speak. One is that it could be that super spreader events are no longer happening. It's Friday, normally after work, I'd like to go for a beer with my friends.
I think we lost Kevin on a note that he likes to go have a beer with his friends on Fridays. So maybe he left us for a beer with his friends for just a minute. Give us 1 second. We'll try and get him back online. For those listening in, just give us 1 second here. While we're waiting for Kevin to come back online, I thought maybe a good moment to pause. There's a Q&A section at the bottom of your screens. I've got a lot of questions that this conversation is kicking off for me. So if you have some questions, feel free to start putting them in the Q&A so we can queue them up while we're getting Kevin back on board here. And we'll take them at the end of the presentation. Kevin, are you back?
I'm here. Can you hear me?
We can.
Okay.
You left us on a note saying you like to go to the pub on Friday, so it was kind of a perfect frozen moment.
Right. Yeah.
Well,
okay. Sorry about that. Well, I've been going to the pub a lot less on Fridays now, and that's probably helped to slow the spread of the virus. So yeah, super spreader events, things such as bars and indoor venues with lots of people, clearly those are ripe atmospheres for the spread of the virus. So that could be the thing that's causing the decay that I was discussing. But there's also other possibilities. So there could be heterogeneity amongst individual populations. Other people may not enjoy going to the bar as much as I do. So those people would have been, in a normal world, much less likely to spread the virus. You can see politicians all around the world now seem to be catching it. So athletes too. So people who interact with lots of people on a daily basis, they're probably the ones who are spreading the virus much more than your average person. So once you essentially get them, once they have caught it, then they're no longer able to spread it, and that may be what's causing it. There's also some research that suggests that probably more people have been exposed to it than antibody tests suggest. So this is still an unknown area of research, but there are studies, for example, showing that within families, one infected person who's positive COVID hasn't infected other members of their family, but those members have elevated T cells responses. And so what that would mean is that the body has a natural protection to the virus, and so they don't need to develop antibodies. So it could be, and that would be really good news, is that in a way is that more people have been exposed to it, and so fewer people can get it. Could also be that personal hygiene measures have increased and they're not captured by mobility data. I think this is definitely true. Those places that have been hardest hit are probably going to be more careful with social distancing, washing their hands, wearing masks. So you've seen in each country probably there was not really confidence, I want to say, but maybe until you really get a sort of a critical mass of people being infected, then behaviors that we're used to are very hard to dislodge. And so if that's true, it's something to be aware of, that we need to continue doing this, because if we become too relaxed, then it'll simply come back. And finally, it could be that it's seasonal and that places such as the northeast of the US and Europe are in summer now. And so people are just outdoors more, and this is what's causing it. We've tried to find any statistical evidence of that, and we haven't. And the literature also has looked into this, and they haven't really found much. But if that were to be true, then that would obviously be terrible news, and it would mean that there would probably be severe risks of a second spike as we hit winter, at least in those locations. So overall, we're not really sure. We think there's probably a mixture of all of the above, and probably some stuff that we're missing. But the fact that this statistical finding is true across countries, over 100, as I said, and it is true also across US states. I know clearly there's large outbreaks going on right now in certain US states, but the finding is true there. It does mean that we are confident that the world can continue to normalize. Probably the US has been a bit more delayed. The news over the past few weeks mean it's going to be more delayed than we'd expected a month ago. But if we're right, I would expect cases to probably flatline within the next 10 days to 2 weeks in the US. And then slowly start to decline from there. And if that's true, then I think what we've seen in terms of economic recovery can continue. So it won't really be a W, it'll be more of a stalling of the initial recovery. And then we should be able to move forward and continue to see a recovery gain momentum as we move forward later in the year. So yeah, that to summarize basically means for us, a V is very much on the table in our view. And to be clear, I think all of us are using alphabet letters to define the path for the economic recovery, which is probably a bit simplistic. We've done it, but we like to clarify what we mean by a V. And so for us, a V is defined as GDP returning to its 2019 Q4 level sometime around the second half of next year, maybe Q3. And so some clients have said that's more of a Nike swoosh. Don't really, I think as long as we're clear about what we're defining it as, that's our view about what can happen, and that's really based on the expectation, some hope, to be blunt, that the virus can be contained and that we can continue to normalize in a good and positive way. However, the fan chart, as you see here, is extremely wide. So for us, this is the distribution. 90% of all outcomes are represented on this fan chart. And so you can see there's clearly a big risk that we hit something that's pretty bad and close to the Great Depression if you move to the 10th percentile. But on the other hand, there's also the risk of a quicker and faster rebound, particularly if there's progress either on antivirals or on vaccines. And so we're saying we've upgraded the weight that we attach to our V scenario. And so that's gone from 40% to 60%, not predicated both on a faster bounce back that we've seen in recent weeks and months, but also on this finding about the virus and the experience of European countries that have suffered pretty large outbreaks, but have been able to ease quite aggressively without sparking a second wave so far. To conclude, we think the V is mostly priced into equity markets to a large degree. So while we're at 60%, we're saying equity investors are 110% on the V. Some of that may be due to some form of central bank action. I guess a lot of people point to that. But we think even in our relatively bullish case in terms of how the economic trajectory could move forward from here, we think that, equity markets return to equities may be capped, both because there's a lot of positivity, it seems, already priced in, but also because you could expect to see yields rise in that environment. And so that could probably weigh on equity market returns as well. So that's our view, outlined a Fathom view, but you don't have to take our word as gospel. I'm sure all of you are as informed, if not more informed. So to close it out, to see how far we are from our audience perspective, at least, we're hoping to get your perspective on when do you think US GDP will recover to its 2019 Q4 level? So that was the final quarter before the virus really affected economic activity in the United States. It's fairly simple. 2020, if you're a super V, I would describe that as 2021, 2022, somewhere between there is sort of a U, I guess people would argue, and then 2023 or later for the pessimists out there. So I'll close the poll and see your responses. Okay, so we do have a few Uber bulls there in 2020. That's good to see. And then fairly evenly split between 2021 and 2022, with 5% thinking 2023 or later. With all due respect, I do hope that the final group are completely wrong. Time will tell. Thank you all for joining this session. As I said, do be in touch. I think there are some questions which we may be able to get to, but I'll pass back to Refinitiv at this time.
Thanks so much, Kevin. It's been, I think, very refreshing to hear the Fathom view, which definitely seems to be differing from some of the opinions out there, and to know it's based in economic modeling and data analysis. So leaving the presentation probably with a bit more optimism than I started with, which is helpful and good to hold on to. We're going to open it up to Q&A. There's a lot of questions that I think I'm hoping you're asking. Otherwise, I'm happy to ask questions, a lot around the U.S., given based in New York. But before we do so, and while we open up Q&A, we're going to turn it over to Ben Charette from Refinitiv, who's going to talk to you about DataStream and how you can model some of the scenarios using our platform from Refinitiv. Over to you, Ben.
Thanks so much, Rachel, and thanks again, Kevin. I'm with Rachel on that. That made me feel a lot better than I did probably 35 minutes ago. So thank you again, and thanks everyone for joining. As Rachel mentioned, this series is actually a partnership between Refinitiv's DataStream and also Fathom and some of our other partners. And for those of you who don't know what DataStream DataStream is our time series historic database. It's actually the largest time series historic database in the financial industry. But not only do we have an unbelievable amount of content, but we are also hands down unmatched in terms of historical financial data. So all the content that Kevin went over today actually did come from DataStream. Much of the analysis he did, I'm sure, was within DataStream. But when you look at our platform and the Refinitiv offering, it really is, it's a dynamic platform that has advanced charting capabilities like the ones you saw today. So 90% of those charts I saw in Kevin's presentation were done within DataStream. All of our customers have access to the exact same data and the exact same capabilities, so that you can take those charts that Kevin showed today and recreate them, consistently monitor them to see if Kevin's V shape is as accurate as he says it is, and that hopefully as accurate as I hope it's going to be. And then also the one thing I did want to mention is the evolution of the data feed and this enterprise solution, and I'll talk about that in one moment. The one thing also I wanted to let everyone in the audience know is that DataStream isn't just a database. It's also got very powerful analytics functions that we have built into the platform to make it easy for you, the end user. Right, so we have the capabilities to create calculations right in the system, and this is a huge benefit to our clients, because what we like to say on the DataStream team is that you have more time to analyze the data rather than standardize it or clean it up. It's already clean for you, and then you can then make that informed decision that Kevin was talking about to move forward with your actions. DataStream is a cross-asset database, although there are certain asset classes that it is known for. So highlighted in this presentation today was the economics and some of our economic forecasts. All of the Fathom charts are also included in that. But we also do have many other asset classes that you can see in front of you, and happy to, once again, jump on a call with anyone to explain specifics on this asset class. But some, to name a few, are our equity indices offerings, our very trendy and popular ESG data is within DataStream. So just to make everyone aware, while economics is a leading indicator and a main driver of the DataStream database, it is a cross-asset content set. And the last, and then also we do have our unique data that I wanted to talk about. So while this is an aggregated platform, there is some very exclusive content and powerful content that is listed in front of you, highlighted, of course, for this audience by the Refinitiv Comparable Economics, which is a standardized content set for all key economic indicators. So very popular, I'm sure, for people like Kevin to make their lives a little bit easier, as well as some of our IBIS global aggregates, to name a few. And then in closing, I just wanted to bring up the enterprise solution. So Rachel and her team, as well as my team, has noticed that there's a real trend in the market for our customers right now with the enterprise solution. Customers have been requesting to have open architecture, access to this content via Python, R, MATLAB. They're building their own data lakes. They're building their own internal systems. And Refinitiv has definitely listened to that feedback, and DataStream especially has listened, because many of these individuals wish to use our content to power their systems. And so I just wanted to make everyone aware on the call that this is a huge trend, and something that the DataStream team is very excited about, and happy to discuss exact customer use cases or possible ideas for your exact project. So please feel free to contact your account team or the DataStream team directly, and we're happy to have that discussion about ways that this content can help your group and your firm. And I just want to close in saying that the DataStream content is vast. I mean, we always say that there's so much you can do with this content, especially during this time. I think Kevin said it perfectly, right? Being the most informed possible is the best way moving forward, especially in these unprecedented times. And so please feel free to contact your account team, your Refinitiv team, as we would love to help DataStream help you. But thank you very much for listening. I am going to turn it over back to Rachel for those questions, as I'm very excited. I might have my own personally, Rachel, so I might send you one as well. So over to you, Rachel.
All right, great. Just as a reminder, we've got a few questions coming through, but you can submit your questions and I will pick them up with as much time as, with time permitting. Hopefully we can get through all of them. There's a question that came through that I think is interesting, and I also had a similar thought. You know, when we started to get into the good slides around the number of new cases, when we talked about the United States, there was, I think, Kevin, the view from Fathom was really we're still in the first wave in the U.S., given that a number of states were not necessarily seeing the peaks prior and are just now experiencing what you would probably consider their first wave. And so the question that came through is, you know, why do you think that the increase in new cases will flatline and start to decline in the next 10 days? You know, what's the view from Fathom there?
Sure. Yeah, so I think that, to be clear, you know, 10 days, I wouldn't, you know, put my house on it or anything like that. But I think from our perspective, what we're looking at, and again, this is just looking at the experience of other countries and also other states, is that over a certain period of time, once the outbreak has become sufficiently widespread, that it slowly starts to decline. And so if you track that forward, in our estimation, within the next couple of weeks, you should see enough of an impact from that to weigh, even if you held mobility constant. And so you should see enough of an impact from that to kind of erode the increase in new cases. And so it could eventually flatline it. As I said, we don't know what's causing it, so we can't be definitive, and I'm certainly not completely certain that that's what's going to play out. So if it was something, for example, about super spreader events, and for some reason certain states continue to allow those, then they could continue. If it was something to do with personal hygiene, clearly masks have become a bit politicized. I don't think masks are enough alone to explain what's happened, but perhaps if you add in just a general attitude, it could be different, and so things could start to increase. But overall, if you look at just what's happening in the states that are affected, that we think, particularly Arizona and Florida, probably by now, it's been long enough that we should start to see some plateauing in terms of what's happening with new cases. And if you look at the US caseload overall, the increase is slowing. I know it doesn't sound like that. I wake up every morning and it hits a new record. But that number in terms of daily cases that's happening across the US is increasing at a slower rate. So to some degree, even from a simple naive forecast, if you just looked at how fast it's growing and push that forward, then you would expect some sort of plateau. I think the dangerous thing is that for the US is that it could plateau at a really high level. And so there's not that many experiences of countries where that's happened. So in most places when the spread was really severe, then they did impose lockdowns, which not only do you get the benefit from time, and so from this, some epidemiologists call it dark matter. Essentially, they can't really explain why it's happening, but it's happening. But you also compounded that effect by lockdowns. Clearly, there's little appetite, I think, in the affected states to return to full lockdown. And so the situation could play out differently in the US. But I think overall, our assessment of from a statistical perspective of how it's played out elsewhere is really the reason why we think that. I wish I could be more certain about what the cause was, and clearly if we knew what was causing that, then we can be much more targeted in our responses, and that would help everything overall. But for now, the sort of a naive, we know that it's happening, and we think and we see signs that it is already occurring in the US, and we think if we move it forward over the next 2 weeks, that we should see further signs of that.
Yeah, there's a related question that came in, and sorry, I can't see who's submitting them, but I think it's related to the discussion and probably just worth reading off because there's some input from the participant around the rules of pandemics and the speed of spread. So what this participant contributed seems like the rules of pandemic is the spread continues until either herd immunity is achieved or there's an effective vaccine. So perhaps this herd immunity is what we're looking for in terms of that plateau. Basically saying, look, the speed of spread can be slowed but not stopped unless the disease is completely eliminated. For example, New Zealand. At best, we have about 10% of the world's population infected. But putting out there, food for thought, about 60% of the way to go until herd immunity is achieved. Just maybe wanted to get your reaction, right? And knowing, this is a economics statistical founded conversation, but just wanted to put that out there. I thought it was an interesting contribution from a participant.
Sure. Yeah, I mean, part of what I touched on was sort of related to herd immunity. So the 60% figure, I think that participant is quoting that relates to the way you calculate that is based on the R. So how many infected people one infected person passes it on, how many people one infected person passes it on to. And so if it's 2.5, then you need 60% for the virus to die out. But one theory that we have, and which I think is plausibly true, is that because people are different, that if you just look at the average R, it doesn't necessarily, essentially that 60% figure may be incorrect because if the super spreader theory is true, which I think it probably is, that there's huge variation in individual human behavior, and some people meet 100 people a week and some people meet nobody a week. And so all of us have a different R. So if you are the leader, a CEO of a Fortune 500 company, or a politician or an NBA player, your R is going to be 10 or 15, whereas there are going to be a lot of people whose Rs are 1, basically the people they live with. And so if that's true, and there's evidence that 80% of the infections do come from 10% of the people, then the effective population you need to have caught the disease becomes much lower. And so it could be numbers that are closer to 20%. So we're still not quite there. But I think that, so I think that's one reason why we could be more optimistic. But I think I'd go further, and I think certainly the virus won't be eradicated until we get herd immunity, either through sufficient people having it that they can no longer pass it on, or a vaccine. But there's different ways that can play out. So if we get numbers to low enough levels where we can essentially have relatively normal lives, and New Zealand is one example, but I think it's kind of a small island in the middle of nowhere, and they can't allow anybody to visit, and so it's not really something that we can replicate anywhere else in the world, right? But if you look at Taiwan or Hong Kong or even South Korea, China even, these are countries that have had outbreaks to some extent, Taiwan not so much, but all of them have had fairly large outbreaks and have been able to suppress the virus and then contain the virus. So clearly, I was talking about what's happened around the world. I think this is a sort of second best world that we're in. Ideally, what we would have done is lock down quickly and hard and then try to operate some form of test, trace, and isolate. So I think we're not complete bystanders to the virus. If we have massive testing, even if the virus is in general circulation, then you should be able to contain it at very low levels. And there's plenty of countries where that's happened. In Europe, to a large degree, that's what's happening right now. So certainly we wouldn't have eradicated the virus, but we would have been able to achieve something pretty close to normal while keeping the virus spread at fairly low levels.
Great, thanks, Kevin. I want to maybe shift focus to some of the metrics we looked at. You had a chart around permanent and kind of temporary unemployment and what are the potential impacts there. What do you see, and I think this is an interesting one around, well, I won't lead the witness. What do you see as the long-term kind of post-vaccine or post-flattening impacts of COVID to our lives? I think there's a conversation around psychological impact in there. So just wanted to get your views on that. Sure.
I think I'm more skeptical probably than many of the analyses I've seen on this in terms of how our lives will change to the extent that I think we, as humans, we like certain things and we're going to continue to like them. So bars in my case. But there's clearly going to be, if we're talking about post-vaccine and zero risk, one obvious thing is city center. So right now I sometimes go to our office and so I ride through the city of London, which is an entire area, which is giant skyscrapers, but with a bunch of different businesses all centered around catering to thousands of people coming into a big office and working there. So I think, a lot of shops, Starbucks and stuff that are essentially there to cater to office workers are going to suffer, and train lines. I think probably I enjoy traveling, but probably business travel to some extent can be overdone. So it's clear that's going to come down, I would say, even in the post-vaccine world. One way we had to think about it, and I guess people can then come up with their own list of what they think may last and what may not last, is things that we find boring and useless are sort of the things that will go away. And so in our company, people who used to commute for an hour and a half each way, for them, they realized that the commute was a waste of time and that they didn't really like it. But things that, that we enjoy and that have some purpose, like bars or restaurants, hanging out with your family, I think that's certainly going to remain. And there's probably other things that we thought we would find boring, but we actually find useful. So I know a bunch of people who started baking and, I don't know, generally becoming a bit more handy. Personally, I think that might wane as things normalize, but for the moment, people do seem to be a lot more into cooking and stuff. So who knows, if people do enjoy that and they're able to find things, new passions, then those are probably the sorts of things that will continue.
Yeah, once the bars open, perhaps the baking will fade away.
We'll say, yeah, I would say so.
So, and it's interesting you call out a couple of sectors there. I think 2 weeks ago, perhaps we hosted a session with MSCI, their head of real estate, talking about some of the commercial real estate impacts and the long-term, maybe structural changes that may occur there. As somebody who lives in downtown Manhattan, obviously watching closely both commercial and residential real estate, I think on a daily basis, there's about 4 moving trucks on my street right now. So it'll be interesting how specific sectors are recovering. And that's something that back in the financial crisis was a familiar scene. So just, I think some of those specific sector impacts that you've called out are something as well. Talking about the V-shaped recovery, hopeful for a V-shaped recovery. What are some of the metrics that Fathom's watching to assess the outlook?
Mm-hmm. So yeah, we're assessing tons of data all the time. It is challenging to some extent because a lot of the sort of surveys that we historically looked at are, I would say, close to useless to some, like the PMIs, for example, they're pointing to continued contraction in May and June, where that was clearly implausible. And so, yeah, like most other people, we're using kind of alternative high frequency stuff and, throughput at US airports, how much people are flying, stuff like pollution, general mobility, a lot of stuff that, normally we wouldn't look at, but since the change in economic outcomes is so huge right now, restaurant bookings, OpenTable. So a lot of places have been good to highlight that, and we are tracking those things. That was kind of the middle portion of my presentation. I think that a lot of the broad swath of data suggests that there has been a decent recovery so far, and probably larger than I had expected. But the number one thing is clearly the virus, and so that's the number one risk to the outlook. Because if the virus comes back in a big way, or it doesn't go away in the US's case, then the sort of support measures that are put in place, eventually you can't prevent businesses from going under. You can't prevent people from becoming permanently laid off. And that's when you get into a really bad scenario. So yeah, no, we look at, what's happening across countries. And then again, as I said, across individual US states. And so from our perspective, we've really tried to learn as much as we can about the science and then try to bring some of our own economic and statistical methods to bear and try and watch that. But yeah, really it's the virus. That's what's going to decide how the trajectory of the economic recovery.
Thanks, that's helpful. And there was a question that came through from a participant about navigating some of the data that you shared within the data stream platform. For those of you who want to access the Fathom charts that do a lot of this modeling and analysis, the Fathom chart library is in our platform in the data stream chart studio. So you can start to leverage the work that Kevin and Fathom have done to dig into some of those metrics and create your own views and lean into some of that data, including on the equity market. So there's a specific question about accessing, some data from NYSE. All of that you can get in the platform and or leverage some of what Fathom's already modeled out for you as the access point. Ben, do you have any questions? I just want to give you seemed eager, so I just wanted to see if you wanted to ask Kevin any questions. Well,
my only one is, Kevin, your thoughts on the initial jobless, the new claim that came out for 1.3 million. I mean, any thoughts, or what's Fathom's take on that? And was that expected, not expected? I know some of my colleagues were saying that's a little, that they thought it was a little high, so just curious your thoughts on the new release of data.
Sure. To be honest, the claims data, that was what we were watching, particularly at the beginning when you saw that huge spike in claims. And I think that was, when I had to put a forecast in end of March, I think, and it was 3 million for initial claims, and the previous record was 700,000. I was scared to submit it almost because I just couldn't fathom that it could be true. So that's one of the things we've been watching really closely, but they've let me down because I was using them to try and forecast payrolls, and both times the claims data painted a sort of more pessimistic picture than what payrolls did, and I think payrolls is a more robust survey and overall figure. So yeah, I think initial claims came down, which is good, particularly given what's happened with the pause / increase in restrictions in particularly Texas and California. But continuing claims continue to drop by a decent amount, 700,000 or so. So that's still pretty good, and I think that was for the end of June. But overall, it's become hard to see, how to translate those initial claims figures, because you're still getting 1.3 million, and 1.5 million on average, maybe in June, in a month when there was 5 million net creation. So clearly, there's some people who are losing jobs, and then some people going back, and so the employment just shows you the net figure. But I think there's issues in terms of how states are reporting that, and somebody filing for a claim doesn't mean that they're approved. Plus, I think there's also issues, maybe multiple people filing, or they're counting the same claim again. So yeah, overall, I think we're looking more closely at continuing claims just because we're finding it hard to make much sense of the initial. And on that metric, it's showing, yeah, kind of a slow but gentle recovery, a bit less strong than what the employment report is showing, but still consistent with continued growth at this point.
Great. Thanks. That was my question, Rachel.
All right. So Kevin, thank you so much for joining us. Thank you all. We're at time, so we're going to wrap it up. Thank you all for attending today's webinar, and be sure to look out for an email with the slides from today. There was a couple questions that came through about that, as well as the recording and a takeaway guide.